Good morning, everyone. Welcome to this timely session on Big Data meets Artificial Intelligence, a perfect storm for financial markets, supervisors, and sustainable development. Also, a big greeting to our international audience who are watching us on webcast and listening to the podcast. I am Babak Abbasszadeh, CEO of Toronto Centre. We were established in 1998 to promote financial stability and inclusion by providing high-quality training programs for supervisors and regulators. I recognize a lot of faces that have worked with us. I'd like to acknowledge our chair of the board of directors, Governor Stefan Engves, who was here. Okay, right there. Aditya Niren, another member of our board of directors. Clive Briot, chair of our banking advisory committee. Andrea Corcoran, she's still here. She's a former board member. And of course, the team of Toronto Centre who's worked so hard, including Medcraft. Today, we are discussing whether big data and artificial intelligence can play a vital role in achieving SDGs and the implications for financial inclusion, climate risk, consumer and privacy protections. New technological developments have triggered profound changes in the financial sector. With the rise of big data, we have better information and tools to analyze that information, which enables us to make better informed decisions faster and improves productivity. The opportunities related to big data are plentiful. However, there are also numerous challenges and risks. These innovations can be disruptive and vulnerable to manipulation and cybercrime, thereby increasing systemic risks. They need to be supported by appropriate policy and supervisory attention at an early stage. Financial supervisors play a big role and must work collaboratively with multi-stakeholders within the development ecosystem and design risk-based oversight. Supervisors must strike a balance between mitigating risks to financial stability while promoting innovation and protecting consumers. Today, our distinguished speakers will share their knowledge on this complex issue, which has been a subject of a lot of discussion, which is right at the proverbial fork in the road. One path can foster the public good and inspire public's trust. The other might lead to some version of dystopia. In closing, I would like to thank Toronto Centre's key sponsors, Global Affairs Canada, Swedish SIDA, and the IMF, who share our concern for promoting financial stability, fostering financial inclusion, and achieving sustainable development goals. Now I will ask our first two speakers to come and make their brief comments, and after that the panel will start. You have already seen their bios, so I'm only going to draw on a couple of highlights. Cecilia Sharp is an Assistant Director General at Swedish SIDA. She heads the Department for International Organizations and Policy Support. In this responsibility, she provides major contributions to Sweden's multilateral cooperation and coordination efforts. Prior to her current role, she had a distinguished career at UNICEF working on water and environmental issues leading to global consultation, and also at the Swedish Ministry of Foreign Affairs. Cecilia, please join us.
Thank you, Babka, for such a nice word and introduction. I'm really thrilled to be here, and I would like to start with congratulating the Toronto Centre organizing today's event. And I'm, of course, really honored to be able to have the inaugurating speech, which is around big data, artificial intelligence, as you said, financial markets, supervision, and sustainable development. And I feel that's a mouthful. It tells something about how complex these issues are. I think that it's important that we are all engaged in discussions about the possibilities, but obviously also the risks that arises from big data and AI. And in particularly, from my point of view, what it means for our partner countries and their AI readiness. AI and big data are indispensable, and this becomes apparent when looking at emerging practical applications of AI. Big data has, at the practical level, been around for much longer than AI solutions. It was years ago now that we started to see how big data can be used for better planning and management than with traditionally gathered data. For development organizations such as SIDA and our partners, the use of big data from mobile network operators can be used to understand, for instance, the spread of infectious diseases, or simply understanding where people are physically located in order for us to bring services where they are most needed. The potential for applications is abundant, and what we see is that increased access to data and lower barriers to the use of IA helps to scale the use of big data in many areas and has potential to fight poverty in all its forms. At SIDA, we have recently taken some interesting strides in using AI for our own work, both internally in the agency to figure out how we can use all the data, for instance, for HR issues, but also as a part of our development cooperation. An area which is at the heart of our mission is to ensure that money we spend reaches the intended purpose and is not diverted by corruptive behaviors and decisions. We have therefore engaged with Transparency International on a project to improve TI's capacity to analyze public records to identify risks for corruption. For instance, in Ukraine, the local chapter of TI has developed its own AI tool to reveal fraudulent bids in public procurements. A different strategy in applying AI for anti-corruption purposes is to redesign systems previously prone to bribery or corruption, enabling AI tools to increase integrity, simplify procedures, or reduce points of interaction may, over time, reduce opportunities for bribery. A group in Kenya have been working with the government to climb the World Bank's index for ease of doing business since already 2014. They identified complex regulations, inefficiencies, and bureaucracy as the primary drivers for bribes. The team worked not only on technical issues with the AI and the big data, but they also worked and addressed the challenges from multiple angles to improve the processes in Kenya. And Kenya has since then climbed from 136 to 61 out of 189 countries on the list for doing business, which I think is really, really amazing. On a more practical level, we must consider that a prerequisite to deploy AI is accessibility and digitized data. Hence, SIDA has engaged in research with IDRC that shows that the readiness of governments vary quite a lot between countries, and there is a continued need to build capacity and to do local research and to support local groups that innovate on AI. Challenges also occur when technology develops faster than legislation and can therefore operate in unregulated contexts. Again, there is a need to support research and build capacity to ensure data protection and keep clients' security in mind all the time. To conclude, it's exciting to see practical implementation of technology data, both for ourselves and among our partners. But we must always remember to give enough consideration to the risks of unintended consequences that can stem from bias in the data used to train the AI system or the machine learning, and in the design of the algorithm. And I think we have seen several cases around the world where the machine training and machine learning has given bias to certain groups or types of persons. This is also why we need to continue to support capacity development and research in this area. We are far from there yet. But I'm really looking forward to hearing the distinguished panel that we have here today and help us to move this agenda forward. So thank you all, and I really hope this is an inspiring meeting and discussions with all of you. And let me hand over to you, Babka.
Thank you very much, Cecilia. SIDA's leadership in this area is very important. Our next speaker, he has quite an accomplished background, so I'm not going to be able to do justice to his bio, the condensed version, so I encourage you to please read it. Tobias Adrian is the IMF Financial Counselor and Director of the Monetary Capital Markets, where he leads the IMF's work on financial regulation, debt management, and capital markets, and he also oversees the capacity building effort in these areas. Prior to joining the IMF, Mr. Adrian was Senior VP of the Federal Reserve Bank of New York and had a front seat view of the global financial crisis, and the Associate Director of Research and Statistics Group. He's also a noted scholar and a published academic for another lot of major economic journals and finance journals. He taught at Princeton University, holds a PhD from MIT, and other advanced degrees from prestigious UK, France, and German institutions. Tobias, please.
Thanks so much for the Toronto Centre and the Swedish International Development Association for the opportunity to speak on today's panel on big data and artificial intelligence. I would like to set the stage by highlighting what the IMF sees as the key issues in this area and what our thinking is. Big data and artificial intelligence go hand in hand. It's hard to do one without doing the other. On the one hand, it is difficult to make sense of extremely large data sets without AI. On the other hand, AI techniques, including machine learning, typically require large data sets for training and validation. Data-driven, algorithmic, high-frequency trading has been around for some time. This has brought improving price discovery and liquidity. Market participants are continuously looking for new data sources, for instance, by analyzing social media, using satellite photos, or by analyzing facial expressions during press conferences. A Bank of England and Financial Conduct Authority survey of UK financial institutions released on Wednesday found a growing traction of AI. The median respondent is already using live machine learning applications in 2 business areas, especially fraud detection, customer services, and marketing. Fund managers have pursued various approaches to employing machine learning while meeting their fiduciary obligation. There are cases where fund managers were on the point of rolling out an AI-based strategy and backed out because they could not get comfortable with the handing over the reins. In past instances, machine-guided high-frequency trading is thought to have caused or exacerbated market glitches such as the flash crashes. Diagnosing such glitches, which is already challenging, may become more difficult if misbehavior by machine learning algorithms cannot be attributed to flawed reasoning or coding errors. Securities regulators themselves are leveraging AI on their work. This is generally referred to as soup tech. This has included analysis of transaction-level data from market exchanges, as well as work with unstructured data, such as regulatory filings, to identify potential fraud in regulatory filings to guide prioritization of enforcement. A number of regulators have put in place requirements for machine-readable regulatory filings, which will facilitate this type of analysis. Consider also the potential impact of big data and AI on banking. Traditionally, customers have obtained banking services as a bundle, with a single bank providing the customer interface, as well as middle and back office functions of deposit taking, lending, payments, and other banking services. However, fintech is setting a trend towards unbundling these functions by new entrants offering a smoother customer experience and tailored financial services. This unbundling creates opportunities to leverage big data and AI, particularly when combined with a push in some jurisdictions toward open banking. Furthermore, the non-traditional utilization of data sources and methods to assess risks and reach underserved populations is an opportunity. Bank supervisors will need to monitor closely whether innovation is overtaking the capacity of banks to adapt and mitigate resulting risks. Let's also consider payments. Mobile payments have improved financial inclusion, provided access to almost anyone with a mobile phone. This has been true in East Africa, India, and China, and has spread to many other jurisdictions. For instance, in sub-Saharan Africa, mobile money account ownership rose from 12 to 21% between 2014 and 2017. Payment providers have begun leveraging their data on users' transactions to offer value-added services, including loans, furthering financial inclusion. Regulators need to ensure that these new financial market infrastructures do not create new systemic risks. The IMF engages with big data and AI-related issues through its broader work on fintech and data governance. This has included developing the Bali Fintech Agenda with the World Bank and internal work on big data and machine learning, such as yesterday's Big Data Surveillance Challenge, where staff competed for support for their big data applications for monitoring economic and financial risks, monitoring key economic activities, and identifying turning points. The data sources in their proposals range from satellite imagery to high-frequency market data, and the topics covered climate risk, financial integrity, and financial inclusion. So very quickly, big data and the AI applications will become part of our day-to-day work as well. As one example of how the IMF can incorporate big data into our work, we have recently designed a data visualization tool with Carnegie Mellon University that helps us monitor the emergence of housing market hotspots as well as countries' policy responses. That knowledge can help authorities decide how to deploy macroprudential tools to contain vulnerabilities from elevated prices in housing markets. Let me conclude. The availability of big data and maturity of AI techniques have reached a threshold that sharply increase their effectiveness, initiating a self-reinforcing rush to find new applications and new data sources. A robust data infrastructure is needed, with a careful attention to issues including data ownership, protection, privacy, cybersecurity, operational and concentration risks, and customer protection. Big data and AI are also helping to improve financial inclusion and to meet the Sustainable Development Goals. Nevertheless, globally, some 1.7 billion adults remain excluded, with women, the poor, the young, and the rural population disproportionately excluded. We have some ways to go. As we go down this path, it is important that the regulatory responses should be proportional to the risks, avoiding unduly stifling innovation and inclusion while promoting global consistency. Consumer protection may also need a fresh look with safeguards against being excluded by algorithms. Finally, legal frameworks may also need to adapt to ensure calibration of new risks, legal certainty, predictability, and balance between transparency and privacy. Let's now turn to the panel. I look forward to hearing the discussion.
Thank you very much. Now for the good news. This is the last time you'll see me at this podium. Thank you very much for both speakers for setting the proper context. Now it's my pleasure to introduce Aditya Niren, who's a very productive member of the Toronto Centre's Board of Directors. He's a deputy director at MCM at IMF, primarily responsible for their technical assistance aspects. He represents MCM at the Basel Committee, and he's conducted a number of FSAP missions, most recently in Canada and the United States, and most importantly, he's a member of our board again. Thanks.
Thank you, Babak. It's great that Tobias and Cecilia have really set the stage, so I don't have to do much. And while they were talking, I discarded most of my opening remarks. So thank you for that. But I'll just make a couple of points to set the stage. We've learned, we heard, of course, that big data is both the structured and unstructured data that is being generated by every aspect of our human existence today. Of course, the issue is that much of this data is not likely to be stored, and that which is stored is not likely to be analyzed. And that, in any sense, which is collected is probably most of it is not collected by any informed human consent or knowledge. So that's one set of issues. Secondly, we are well aware of the power of artificial intelligence, the development in algorithmic techniques and computing power, which now enable us to look for and recognize patterns across really large swaths of data. And as Sundar Pichai has very famously said, artificial intelligence is going to be bigger than even electricity or fire. He said it's revolutionary. But revolutions are good for some and bad for the others. And that's, I think, something which we have to keep in mind as we discuss our topics today. The benefits of the innovative techniques are well known, and they were listed out by the previous speakers. They're used in financial inclusion, in risk management, fraud detection, targeting sales, fighting crime, predicting weather patterns, all of these, some of which you will discuss today. But there are other aspects which we have to keep in mind as we approach a more balanced outcome of our discussions. On competition, much of our data rests with the big techs, who are also the ones making the most progress in deep learning. And this could upset the competitive equilibrium in the financial markets. There are ethical issues of consent, of discrimination, bias, lack of recourse, false analytics, and even misuse of energy, which are presenting a wider set of issues. And then, of course, there are the implications for jobs. It's been famously said that the third industrial revolution automated physical labor. The fourth one is automating mental labor. So what does the future hold? How material are these issues, and how should we be keeping these in mind as we gradually hand over our minds to the machines? That's something which we are going to discuss today. I don't have any answers. I only have questions, and I have a great panel here who are going to answer all these questions.
How long have we got?
Let me start with our first panelist, Greg Medcraft. He's very well known to us here in the IMF. He was earlier chair of the Australian Securities Commission. He was a member of the Financial Stability Board, chair of IOSCO, but is now in his new life spearheading the work on fintech at the OECD, among other things. And he obsesses personally with two sets of issues: on the policy issues related with issues like competition and consumer protection, and on technical issues like blockchain and DLT. So Greg, you're going to set the stage for us. In terms of all the issues that we heard on big data, AI, and sustainability, what do you see as some of the most promising financial technology innovations, particularly those which would support sustainability?
Okay, well, I think that, obviously things are moving pretty fast at the moment, frankly, and I think that some of the innovations that we're actually seeing, I won't talk about Libra this morning, because I think we're going to be talking about that probably for weeks, actually. So, but I think just talking at the issue of big data and analytics, I think, to your point, I think they are going to transform the economy in the financial sector. And I always think it's really interesting on this, which is, the scale of transformation. Just, today we create around 33 trillion gigabytes of data a year, but we only use 1% of that data. And it's increasing. So by 2025, that number is going to rise fivefold to 175 trillion gigabytes of data. So we're going to have even more data and therefore more potential for application of AI. So it's to your point about, it's going to provide incredible ability to perhaps turn into value in, say, financial services and beyond, and have, I think, a profound effect. So at the OECD, I think we're just already seeing some examples of it. We know in financial services, Robo financial advice is one example where we're seeing that have an impact in retail investments and pensions. And I think robo-advice is quite good because one of the big issues in financial advice is accessibility. If you can lower the cost to access to advice, people can be more informed, so that's a positive. Thinking about more efficient and sustainable markets. For example, again, back to sustainability, the potential to potentially better understand and price risk for insurance in areas like natural disasters, which although they are becoming more widespread, driven potentially by climate change, we won't get into that debate, but having the ability to use AI to analyse that data to then price risk. Equally, in the issue of cyber risk, again, AI is being used by insurers a lot to look at how they look at patterns and pricing risk. And then to the issue of competition in financial markets, you mentioned about, and we had a few speakers mention in OECD and our competition division, clearly, the issue of big tech and competition on one side, but equally, open data regimes, as was mentioned in the UK, Australia, and I think coming in Europe, where consumers can take their data with them and find and use it for best sort of financial services. So there are some interesting positives about harvesting the opportunity. Then I'd again see also blockchain and distributed ledger technology also as a major part of fintech's ability to deliver on inclusivity and development outcomes. For example, its potential again in financial services to areas that where we have no physical infrastructure. Payments, we're talking about payment systems. So to deliver money instantly and inexpensively, I think that is something that is quite interesting. And I think that, whether it's blockchain or others, I think, this is why Libra is quite controversial, because it will be potentially can do that very quickly, right? But it's got some other issues. So the OECD's motto is better policies for better lives, which in the fintech space means making sure that these developments actually meet the positive potential for citizens while mitigating the risk. So, but I think policymakers, what we've got to be is aware of the market dynamics and how they're changing with new technologies like AI, a little bit to Tobias's comments. For example, considering the possibility that algorithms can be used to collude in markets, right? And we all know about the idea of the fact that with pricing on Booking.com, if they know who you are, they can give you a different price depending on who you are. So I mean, there are issues that come from it. But even, I think also regulators have got to take, I think, concrete steps to build digital financial literacy in their populations, so that equally, rather than banning things, people are empowered, and then you can allow room for innovation while protecting consumers. So digital financial literacy, I think, is really critical and immediately. So one critical issue, I think, that to data is, we're hearing is who owns it and who has access to data is clearly the topic du jour at the moment. Several member OECD countries have developed data portability regimes, but these tend to be sector-specific. They don't substantially break down the current data silos. A smaller number are looking at the concept of self-sovereign identity, which again I think is going to be the discussion probably in the next 12 months is self-sovereign identity, which the citizens' ability to hold and control their own personal data. And I must say, I think, having watched the space for a number of years, I see this as probably the next big debating point. If you're going to have being able to deal with cybersecurity and privacy and data-driven finance, I think self-sovereign identity is going to be the one area I think to watch quite carefully in the next 12 months actually. So lots of benefits, opportunities, but risks we've got to manage.
Well, thank you for these comments, and I think the point which you made about digital literacy beating prohibition and being the most immediate need of the hour in a certain sense is something which we should all be thinking about from the point of view of the work that we do. So let me now turn to an old colleague and friend, Socorro Hazen, who is currently the superintendent of banking, insurance, and private pension funds, and I hope I haven't missed anything. No. Okay. In Peru, and and we learned yesterday at a meeting where we were together that she is also supervising probably what is considered to be the most digitized bank in the world. And she was surprised, I was surprised, but I think by now we know a little bit more about that. So Socorro, you are currently representing the regulatory community in this panel, and so the question for you is, what are you concerned about in terms of the use of big data and particularly AI in the financial system?
Okay, thanks, Aditya. Well, this is a really broad issue, and we supervisors have concerns about financial stability. So what are the risks for financial stability that could be derived from these technologies? And we are at the critical juncture in which we have to keep up with developments, maintain a favorable environment for innovation, but at the same time we have to be loyal to our main role, which is to keep safety in the financial system, and safety for the citizens that use financial services. So I want to address 5 types of concerns regarding this. First, there are concerns that are associated with concentration. Second, with data and model risks. Third, with cybersecurity. Fourth, with consumer protection. And last but not least, the obstacles for effective supervision. So let me start with concentration risks. And I can see concentration risks derived from the use of these technologies in 2 different ways. First, within the existing financial systems, who has the advantage to be able to use these technologies, to have access to this data, and the resources to exploit them? Basically, the large banks of the system. So what we may have is more concentration in a system that has already become more concentrated. So in these smaller banks will end up having to outsource the access to this technology with additional risks. The second concentration risk has to do with the service providers of some of these technologies, which are the big techs. So we may end up with another concentration risk, which is even bigger, because we have big techs who are unsupervised, who have no known or able regulator at this time, having the capacity to provide services to entities that take deposits from the public. So that is a big source of concern. I want to leave it at that with concentration. I want to go to data and model risks. Data and model risks, basically, I think some of those issues have already been mentioned. We have concerns about the source, the quality of the data, the biases of this data, the trustworthiness of the sources, and the capacity to validate the quality of information that is being used. And then in model risks, we have problems with model specification, opaque models, difficulties in understanding these models. So all this create risks for the financial system. Then we have cybersecurity risks. And then you have that the intensive use of technology and the use of diverse service providers creates more weak links for a system in which the strength is based on the strength of the weakest link. So we have more weak links that we have to focus on, both banks and regulators. And then there's another risk that is associated with cybersecurity, which is the management of change. When banks try to adopt new technologies, new business models in a very fast way, they tend to empower small groups of people who are sometimes left alone to work, lifting some of the big controls that the financial system has. And there is an additional risk here, which is the capacity to manage the risk of change. Because lifting these controls creates cybersecurity risks. Then consumer protection risks. And then I don't want to go too deep into that because I think it has already been covered. Issues of privacy. Privacy and consent. You cannot be sure what are you consenting to when you grant access to information. Who is going to have access to it? I mean, how many people, how many millions of people are going to have access to your information when you're consenting? And then all this also gives some incentives for predatory behavior and with the risk of overindebtedness of the people. So too much credit can also be bad. And then last but not least, the difficulty to supervise. When you have all these service providers, all these huge amounts of information and data being used in models that are not transparent and difficulty to access information, supervisors have a much harder work. And then on top of everything, you have the unregulated service providers. So you have a different layer of providers that is not supervised, and then you have cross-country problems because these service providers have basically operate worldwide, and so basically there's issues of jurisdiction which are even harder for smaller countries and emerging markets who are may utilize the services but are not in the capacity to get direct access to the big techs as service providers. So I want to leave it at that. What do we have to do? Prudential regulation, work harder in improving our regulations in terms of outsourcing, data governance, model risk, cybersecurity, business continuity, management of change. All these things need to be better regulated according to the new times. And then continue reviewing the perimeter because you need to assess frequently who should be brought within the purview of supervision, to what extent, who would do it, how to do it. So, and then at this point, coordination among supervisors and regulators around domestically and across the world is essential. I want to leave it at that now.
Thank you, Socorro. And
That's
after
good.
listening to you, I realize I'm really lucky I've left the supervision business some time ago. That's quite some challenges that you're facing out there. So I'm going to now turn to our next panelist, Lisa Davis. And Lisa is the Data Governance Officer for City, Treasury and Trade Solutions and also heads the Data Insights and Artificial Intelligence function within TTS. Lisa, we talk about it, you actually use it. So tell us, is this all hype, this thing about artificial intelligence? Are all these risks real? Does do all our concerns really make sense? Are you being able to use this in the manner in which you thought you would want to really use it? Does it all make sense? Back to you.
Yep. Thank you, Aditya. So the first thing I would say is that there is a lot of hype out there about this. And the reality, especially in the financial services sector, is less than the hype. And I'll tell you what I mean by that. I mean, we all love, sort of hype and we love buzzwords. When we heard big data, everyone started jumping on, big data. We gotta have big data before we even knew what it was, before we even knew what to do with it. The same thing with AI, right? A lot of organizations went and said, we have to do AI. AI is the new thing, it's the new oil. We need this oil, we gotta do it. We set up these departments and we hired a whole bunch of data scientists and people that understand this from a technology perspective. And then we said, okay, now what? Guys, go and do something, right? And give us some returns. And then we quickly realized that, wait a minute, that's not the reality, right? It's not what's actually gonna happen. A lot of fintechs and startups have also exacerbated this whole thing with their seemingly sexy solutions, right? And they're going and talking, to organizations, and we can do this and we can do that, and we can take your data and we can turn it into all these other things. And the reality of it is that not so much. And the reason why it hasn't really had that impact yet is because the first thing that we grapple with when we start talking about AI and big data is the data itself. And data is messy, period. We've built out these big data lakes, but if you can't get in the lake and swim with the data and understand it, there's not much you can actually do with it. And I think most of us, have realized, and a lot through the regulatory lens, we've realized that the first thing that we need to do is get our house in order with respect to the data, understanding it, knowing where it is. There's a lot of data quality issues that we deal with on a regular basis. And unless we grapple with that, it's going to be very difficult to do more. Now, the good thing is that a lot of us in the financial sector have been grappling with the data over the last 10, 12 years. Right? From a regulatory lens, we've been digging into the quality, the lineage, the traceability, the ownership, things like GDPR and other things, right? And we're obviously heavily regulated. And looking at the data and actually understanding where its weaknesses are, as well as where we can actually use it to have impact, has been the real work, I think, that's been going on. Sure, some of us have been able, to quickly organize ourselves around, data and around the opportunities to be able to do things that I think are more augmenting at best. And what I mean by that is, we've been in a position where, we have, tons of data, and we can take that data and use it to help, let's say, the sales cycle, the sales organization be better at understanding their clients and understanding their clients' needs and things of that nature. Just doing simple things like analytics and really being able to help our clients, do reconciliation better. I mean, very bottom line, base level things that we're doing with data before you actually get to the more intelligent things. Sure, there are tremendous opportunities out there from an intelligence perspective, from a machine learning perspective, and we can create, graphical representations of our clients buying and selling, components of their entire ecosystem, right? To be able to, do things like recommend, supply chain finance opportunities and things of that nature. But again, I want to underscore the fact that only comes after a deep understanding and a deep governance of the data itself, digitizing it, making sure that we can extract it from where it originates, and being able to have ownership and governance of that data along its journey until it reaches the end state. I mean, that's not an insignificant body of work, and I think most organizations are sort of grappling with that. Having to set up, very strong data governance organizations within, data governance focus within their organization, people that actually own this as a responsibility. Many organizations, I think, have sort of, gone beyond that and said, let's bring in a bunch of, people that, can take the data and do something with it and put machine learning on top of it without actually understanding the underlying data itself. So is it a reality? I think it will become much more of a reality, but I think we have to hit these first hurdles first. And that is, how are we extracting the data and putting it into these lakes? Do we have all of the governance around the data as it sits there? Can we deal with the quality issues of the data? A lot of, artificial intelligence, at least in the financial space, it's really, still focused on what we call narrow AI, which is, using AI for a specific purpose, like to recommend something or to recommend a next best action. Many of us think about AI, from a Netflix perspective or from a self-driving car perspective. And I've even heard, the words of, self-driving treasury as an example. We're very far away from that. I mean, we're still coming out of paper, So, I mean, we have to get to the point where we actually digitize the data first, understand it, and can share it, back and forth. A lot of this new technology gives us the ability to do a lot of different things. But again, that has to be incorporate it into our ecosystems, which in some cases, like in the Citibank example, we're 200 years old. We have to incorporate this into existing rails, into our existing processes. It's not something that's going to sit off on the side and just do something on its own. It has to be part of everyday flow. It has to be part of everyday process. And so the question is, have we really been able to make progress? I think the hype and the buzz around AI has been good in the sense that it's helped us realize that we really need to turn our attention and focus on the data itself, making sure that we have the governance and the ability to first deal with the data and all the issues around it. And I think we have to understand the limitations of AI, especially in financial sector. We talked a lot about, and we heard from just on the panel and with the opening remarks today, that there's a lot of inherent sort of opportunity for the data to have negative impact, where we didn't expect for that to be the case. And so how do we protect and guard against that? I think we must not forget that this whole phenomenon does not happen without people. It doesn't happen without people understanding what they're doing, understanding the data, being able to translate. You can't sit a data scientist in front of a large amount of data and say, have at it, tell me something. What questions do you want to even ask that data? That data scientist probably may not even be familiar with the sector. They may not be the subject matter expert. But we want to sit them in front of a bunch of data and say, tell us something, so that we can be better at selling or whatever we're trying to do. But the reality is that you actually need people in the organization to translate to those data scientists, to make them understand what we're trying to do, make them understand what the opportunities are, make them almost a subject matter expertise. In fact, I would argue that having human intelligence and having the technology and people that understand machine learning have to all sit together in order for this to really be a reality. So the wall between technology and business has to come down, and those people need to kind of ideate and form a unit together in order to solve problems. But most importantly, we have to be smart about the questions we're asking the data. What do we want the data to actually do for us? I think some of the benefits that we've been able to see is relatively quickly are mining like payments data and things of that nature. We can give our clients early detection on where we see patterns going off the rails. So in other words, outlier sort of patterns where payments may not look like something that is standard for that particular organization, and we can highlight that almost instantly and say, hey, does this look right? Is this something that you need to look into, and then maybe stop it from there. So I think we have to balance all of the hype around AI with the reality, and the reality is that unless we can grapple with the data itself, unless we can put guardrails around that and have people that can actually translate, the opportunities start to minimize unless you can actually do that. And I think the work around that is really where most of us in financial are really focusing.
Thank you, Lisa. I think your words have probably given a lot of comfort to Socorro here,
Yes.
in a certain sense. And also to a lot of other people in the room, people like me, that we are now going to lose our jobs very soon. Okay, that's great. So I'll come to our final panelist for the discussion, Curtis Ravenel. Curtis, you lead Bloomberg's sustainability effort. Yes. So you've created the Sustainable Business and Finance Group in Bloomberg. You are on the board of Sustainability Accounting Standards Board, and I confess I didn't know that this existed. And you're a member of the Secretariat of the FSB Task Force on Climate-Related Financial Disclosure, which I know, and I'm very much, in a sense, admire the work that group has done in trying to bring about some order to this very disparate disclosure regimes which are related around trying to differentiate between green, brown, and other colors. And the TCFD, particularly the task force, it's been remarkably successful, and that's why I wanted to turn the conversation a little bit towards sustainability with this question for you. Why do you think the task force recommendations have kind of managed to move the needle, or have they?
Well, I think the recommendations themselves have certainly gotten a lot of attention. It's a little bit like what you were saying. There's a lot of hype around it. We have something like 873 supporters. I was in Tokyo last week, and Prime Minister Abe had a summit on it. It's one of those things where it's an idea whose time has come a bit. I think the real reason, I'd love to say that one of the reasons it's been so successful is because we did such a beautiful job of writing a beautiful piece of work. But the reality was, and is that it was an FSB-sponsored project. And so the focus on financial stability, I think, was really quite smart. It helped us narrow. Climate is a huge issue. We jokingly call climate the big C in ESG, and ESG data being obviously all kinds of sustainability data, much of which has been discussed already. But I think the focus on risk, now the FSB is focused on systemic risk. The task force itself was not charged with trying to determine whether or not there's systemic risk in climate. That was not our objective. The objective was to get better information into the market so that investors and lenders and others could make more informed capital allocation decisions, quote unquote. It was then, if you have an aggregated amount of information that is disclosed by these institutions, then at some point, hopefully the FSB would be able to aggregate that and take a look at it and see if there's systemic risk, but we're very far away from that. I think the other reason it's been successful is because it was Governor Mark Carney and Michael Bloomberg, who are both very mainstream individuals, mainstream respected financial professionals. And so this was depoliticized to a degree by making it that way. And also it ties into some of the things that you all said. The recommendations themselves are relatively straightforward. They're around governance, strategy, risk, and metrics and targets. And they're intended to be integrated into the way a firm is managed already, not as a separate process. Nobody has time to do their current job. And so in a way, I think that design has basically helped people think about climate in the way they think about traditional risk. And I think more companies have realized that climate risk is a big risk to them, but they've never had a real framework on how to think about it. I want to tie it back also to AI and big data, because I do think one of the challenges, one of our pillar recommendations is around scenario analysis. And you regulators on the panel will enjoy the fact that one of the reasons we called it scenario analysis instead of stress testing is because the banks in the room heard the term stress test and freaked out. But let's be honest and say that in a way we're asking them to stress test their strategies, right? They recoiled, and it was visceral. And I think that that's hard to do. And I think the companies, there's more sort of support for the TCFD than there is actual disclosure around it. Part of that is it's a journey, it takes some time. The scenario testing for climate is new. You know, there are some big oil companies and financial institutions have experience with that for other matters, but most everybody else doesn't really. And you're asking to look forward. There's some concern about confidential business information. But I do think it's important for us, we're asking about the resilience of your business strategy in a future world. The financial markets, as we know, tend to be very short-sighted. It's what Governor Carney called the tragedy of the horizons. What I'm seeing, which is interesting, is that the financial institutions who are trying to make investment decisions are not getting the disclosure they want. So they're using big data and AI to create their own narrative around a company's climate resilience, if you will. And so my sort of push to the companies are, you should disclose on these issues, because if you don't, AI and big data may come up with a narrative that you don't like, right? And so it goes back to the point that was made on the panel earlier. I think it's a great, AI and machine learning is a great augmenter. It cannot really replace the complexities of organizations and their business models and how they operate across jurisdictions and all of that, and supply chains and the rest of it. AI can help but it can't replace people. I mean, it's that old saying, garbage in, garbage out. You're talking about asymmetric information, so you could actually just compound the misperception because of that. So I do think that we're on a very early and long journey, and it's got a ways to go, but we took a first crack at it.
Thank you, Curtis. Another point you made about, which was repeated from earlier as well, about augmenting but not replacing, because of the complexities of the organization are such that they are not going to be replaced by an algorithm in a certain sense, is a very important one is to take forward. So I'm going to take a short break here, but not a commercial break. We're going to take a few questions from the audience before we go back to the next round. Sure. So maybe a couple of questions on what you've heard so far. Yes, please. And could you please let us know who you are, identify yourself and your affiliation?
Excuse me. My name is Arslan Khan. I'm a blogger at arslankhan.com. I'm also a consultant on digital transformation. And the point that most folks are making is very valid in terms of strategy. But for me, what I've seen is that when you do digital transformation, the biggest thing to do it or not to do it is culture. Culture of the organization, culture in terms of not only people, but culture of the process that's ingrained in the organization, and beyond that in terms of the country level. So what are you guys doing in terms of addressing that?
Okay, it's a great question. What are you doing to address the culture of the organizations to embark on this journey? Maybe we can take another couple of questions and then answer them all together.
Yeah.
Any others at this stage? Yes, please. One there and one there.
Good morning. Thank you for your time. Kathleen Mystery from Mystery Advisors. I know in a perfect world there's going to be no fraud. There will be fraud. As a personal consumer and as a company owner, I would really like it to be more accessible where I report fraud. To what address do I report fraud? This is difficult from a person's experience at bank when I go in and I want to report fraud and they refuse to give me the fraud address. Now, this shouldn't be happening in any international bank. So if you could offer some suggestions, I'd appreciate it.
Okay, culture, fraud, and the last question there.
Hi, good morning. I'm Jason Balu from the Mauritius Commercial Bank. With the advent of big data and AI, I wanted to know what, in your opinion, are the key factors that the authorities should make allowance for when establishing an appropriate regulatory and legislative framework that is one which, at the same time, leads the way for a disciplined conduct of activities by key market players, and at the same time does not stifle innovation and risk-taking by businesses.
Thank you. Great question. Maybe we want to start from, who wants to go first? Lisa?
I'll take the culture.
Take the culture, please.
Yeah, I mean, I think the question about culture is spot on. And in my earlier comments, I said, this won't get done without a combination of people, the technology, and the process. And so what we're doing, to address the culture issue is, I mean, it's simply, putting people with the data. It's, getting, training. It's bringing people in their everyday job closer to the data. It's making, people responsible. I think, from a culture perspective, one of the things that we've been doing is, bringing in, things like Data Robot as an example, where, folks can actually, understand and deal with the data right at their desk. It is very important that people understand, what data can do and what it cannot do. And creating that culture is, I mean, it's the basics, right? And you have to bring people to the data. You have to, put training, in place. You have to have, a constant messaging around it, and not the sexy type. I mean, I think we all jump to the innovation, aspects of this, and we all want to, kind of get there, and that's great, and that's the end state. But I think, people coming into work every day and understanding that, your job is going to slightly change, right? And your day may start with you, dealing with some level of analytics or, being engaged in that way. And your responsibility obviously has to be to understand where you are, where you sit in that space, and what your level of responsibility is. I think it has to come from the top down and it has to be bottom up. But I think we cannot forget the importance that this whole concept about governance, ownership, responsibility has to be mired in everything we do and the culture that we create around the data. You will not get the benefits of AI unless people actually understand their role in data and how we actually get to these so recommendations or whatever it is that we're producing at the end. And again, the last point I would make is putting the power right in people's hands, right, to actually see and work with the data themselves is really the best way to build the culture around it. Unless you are actually really grappling with it and working with it, it's very hard to understand it, and it kind of seems like something that's just an ancillary thing that somebody else is doing. But my firm belief is that tomorrow we will all be data scientists, and we will, in some way, and we will all have to get very familiar with this space beyond how we are so quote unquote using it. So.
Thank you. Any supplementary comments on culture before we take the next one?
Just a short one. Basically, from the point of view of a regulator, not only the culture of the institution, of the banking institutions have to change, it's also the culture of the regulators and the supervisors. They need to adapt to the new world. There has to be an openness to understand, keep on developing understanding of innovation and of new risks and of the new business models. So there's continuous learning, there's the need for specialized staff, and in this big contest, you need to change the culture of the supervisor. But another thing that comes to mind is that in this context, the supervisors need resources. And so a big issue is autonomy of the supervisors.
Yeah.
You need to have independent supervisors that have enough resources and have the capacity to budget the recruitment and retaining the staff that needs to be retained.
Agreed.
To be able to have the capacity to supervise in a more complex world.
Fortunately, all the ministers of finance are in the building today, so I hope they have. Craig, you want to start with the regulatory framework question, although that's almost the topic for another conference, but still.
Well, just to mention on AI, in May this year, 42 countries signed up to the new OECD Global AI Principles, and including the United States, which really the aim of the principles is to build a trustworthy, AI framework. And basically there's essentially 5 key principles in there. First of all, the need for safety, security, privacy, confidentiality in data are sort of amongst those 5. So recommend anyone that's interested that those, and then there's guidance around those sort of 5 principles. So that's a starting point, at least, to have some sort of global principles, which are sort of, I think, quite common sense in terms of what we do with AI. The other one that I didn't mention was that they are human-centered values is quite important. So, and accountability was another one that was in. So I guess that's a starting to think about a framework, and we hope that next year for the ministers, we were hoping to do something similar with distributed ledger technology in terms of high-level principles, because that's sort of where you start, and then that allows countries at least some global guidance in terms of how perhaps the thinking should happen.
So let me hold you there, and we'll take up your question later as to where do you report an AI fraud. We'll come back to that one later. Greg, while we are on this topic, maybe we could move on to since you talked about the work that the OECD is doing with these principles. In general, and given also your membership of the FSB, what do you think are the areas in which there needs to be greater international coordination, and efforts to harmonize regulations in this whole field of data-driven finance?
Yeah. Well, clearly we've talked about, we mentioned before, it's, data is global, so cooperation has to be global. So I think there's 2 points. One, is that technology and its applications are moving very quickly, very quickly. I remember 6 months ago with the Digital Financial Technology Task Force, we drafted the mandate, and I said, well, what about stablecoin? They said, oh, what about it? And I said, well, I think it might be something like that. It's happening quickly, right? That's the first point. Secondly, as I said, data is a global commodity. It moves across borders. It can exist in many jurisdictions at once, and the same goes for financial applications actually built on top of that data. If we think about the first point, which is it's moving fast, I think that regulators are probably they're not facing the challenge of adapting to fintech alone. So I think it's happening while we're here today. So there is opportunities to learn from one another in a forum like this with the World Bank, IMF meetings, but at other forum like the OECD and IOSCO and FSB, because we're all facing these challenges in our own jurisdictions. So coming together and public institutions comparing notes and experiences, looking for best practices that can be scaled and adapted, even using these as a basis for guidance and updated standards. And I think that's really with our convening power and our policy committees. It's really what we do at the OECD. It's sort of what a lot of international organisations do this. And the most important thing about it is it actually you've got to avoid knee-jerk reactions. We've got to actually learn to understand before you respond to emerging technologies and have a considered view. So I think this is critical. And we're seeing this play out a bit with stablecoin at the moment. Regulators are moving fast to try and understand it and then thinking about, well, how do you respond? On the second point on global markets, we've seen from the recent innovations like initial coin offerings and digital assets are seen like stablecoin. Again, they can move quickly and take a geographic scale very rapidly. Again, one of the concerns about something like stablecoin with 2 billion followers, it could happen very quickly. So, the regulator's main goal should be, first of all, is the level playing field. Basically, avoid incentives for regulatory arbitrage, often a race to the bottom in terms of rules. That helps no one. Weak practices in one jurisdiction can affect consumers in other jurisdictions because, again, it's global. Most importantly for business, getting policy certainty and consistency is really important. What business likes is consistency. And that also allows innovation. Reduces the sort of, if you want, the risk premium on new innovation, and addressing some of those challenges I mentioned earlier. Because some of the innovations that are occurring, I think, are good. I mean, one of the benefits of Libra could be, that ability to deal with the unbanked and cheaper remittances. So it is a catalyst. In doing so, I think regulators, again, have got to be focused on their mandates. In the case of market regulators, fair, efficient, and orderly markets. Because at the end of the day, often what you find, whether it was banking, whatever, often it doesn't change the fundamental. So I think what you've got to be looking at is proactively taking existing rules and international standards and actually thinking about them in terms of new applications. So, and often what you see with now regulators when they're focusing on this, they're looking at the economic function of the product. I mean, that was the case of initial coin offerings. When they came to me, I said, well, it's a collective investment scheme. It's nothing, I don't know why you're sort of debating it, So often it's what the economic function is that's really important, not the technology behind it. So finally, I think what we've got to recognise that many of the issues we're discussing today, again, competition, privacy, data governance, it's a little bit the point you were making earlier. They traditionally sort of sit often in siloed regulators, but clearly, to your point earlier, is actually you've really got to cooperate now. For example, I know from being a former financial regulator, now that I have competition, competition regulators don't know much about financial regulation and vice versa, and more they need to understand one another when they're faced with issues like big tech, right? So collaboration across regulators is becoming more important, and to your point earlier, cooperation then globally is important because the silos are breaking down very quickly.
Thank you, Greg. So let's move now from the international regulations to a national perspective again. And Socorro, this one's for you. One of the things about the use, but this discussion of the application of big data and AI in finance has been how alternative data could be used to drive credit risk models again, to drive financial inclusion. And what has been your experience with this in your jurisdictions, and what do you see as some of the issues arising from that?
Okay, thanks, Aditya. First let me tell you, traditionally, supervisors look into whether banks know their credit risks or of the loans they are originating by looking whether they understand the capacity to repay of their clients. No? So we try to understand how are you measuring the capacity to repay. And traditionally, models or evaluation of capacity to repay had to deal with income and collateral. Those are the two main variables. Income, not always observable. Collateral, not always available. No? So therefore, a huge number of people ended up being left out of the financial system. There come these models and these options to try to estimate capacity to repay, shifting the weight towards different sources of information to try to identify capacity to repay, or to try to infer the non-observable variable income from different sources, expenditure patterns, other things. And that is a shift difficult to make for regulators. Actually, we in Peru, in my agency, we within are struggling with that issue because we cannot agree yet among themselves whether these models are valid, I mean, can be validated, are going to be robust, whether basically we should keep on asking banks to continue focusing on income. And there is a big discussion within my own organization, and I imagine that is happening across the world too. So that is the first point I want to make. Of course, when you compound this not by just simple scoring model, but by using artificial intelligence into it, the weight focus even more away from income and collateral towards all these alternative sources. So then you may end up with origination of credit being mainly a result of something without observing income or estimating income. And that is something that is difficult to accept. The other issues, of course, have to do with whether these models are bought from a third party, which is a service provider that has proprietary information about the parameters and the algorithms and all these things, and therefore the bank cannot know and cannot understand exactly what is this model doing and whether it's going to be robust in different scenarios of the world. I mean, out of sample predictability of these models that the model is giving results, adequate results now, doesn't mean that it's going to give us adequate results in a different state of the world. So if you do not understand what is driving the good results now, of course you do not understand how is this good results, who are these good results going to change in a different state of the world. So that is another huge issue. And then a third thing that I want to bring in, it doesn't have directly to do with models, but it has to do with externalities. When you have the capacity that unsupervised lenders are using scoring models with artificial intelligence and other technology to grant loans, you end up with a behavior that could be predatory, in which banks may not observe the full leverage of the people who are getting the loans. And therefore, if you cannot observe the full leverage, you cannot observe the capacity to repay, because you're not understanding how leveraged these people are. And then the question comes to credit bureaus. If this is going to happen at some point, and it keeps on, I mean, the importance of these unsupervised lenders is growing, there has to be a way to bring the information of these loans to the supervised world so that we can observe leverage. And I want to leave it like that. That's good.
Thank you, Socorro. And this is the point you made earlier about supervisors also have to change their own culture and the way of thinking to be able to adapt to some of the new innovations. So we're down to the last 14 minutes, so I'm going to request quick responses. Lisa, moving on to another one. The alternative data was mentioned here. Data monetization is another word, which is another buzzword which is being used. And what's your views on this? Have you managed to monetize your data successfully?
So, simply put, our data belongs to our clients. This concept of monetizing it, sounds a little far-fetched in terms of, selling back data sets and things of that nature. Just think about the regulatory landscape that we have right now with being able to protect our data, right? And, I don't think the regulation has even caught up yet with, the fintechs and others who are, creating these data sets and, and trying to monetize and so on. Look, I would say from a financial institution perspective, I don't think that would be the focus. I think the focus would be around, how do we better protect the client's data? I think, the benefits of what we do with data and AI will come from its ancillary things and not necessarily, a monetary stream with the data itself. I mean, the benefits will come when we are providing, clients a better experience. The benefits will come when, we understand and can make better decisions within our own organizations. And the benefits will come when we provide value-added services to our clients by, leveraging AI and data, not this sort of concept of, directly monetizing the data. I think that, with the amount of data that's being, created on a daily basis, according to Forbes magazine, some 2.5 quintillion bytes of data being created every single day. I think we have a bigger issue around how do we regulate and protect all of that so that, we don't cause bigger problems than how do we make money on that data. So I would say, simply put, I think, I don't know that there's a real impetus for anybody to think about, at least from a financial institution. We'll leave that to some of the fintechs if they think that's, but I do think the regulation will catch up. And I think the fact that we deal with, extremely confidential PII and other types of data, sort of, that sets the stage, right? And so we should really be thinking about more on the lines of, as we continue to create all this data, as we continue to use it and try to put it into models and doing AI, we should be thinking more about the protection and the management and governance of it, as opposed to, trying to monetize it. And from the other perspective, I think, the better we do that, the benefits will come regardless. So,
thank you for that. And so my last question to Curtis. So yesterday in a panel, our managing director basically gave us our marching orders and said from now on we have to incorporate climate risks into our surveillance activities, which is with regard to our dialogue with our member countries. So we'll all be now struggling to figure out how do we measure these risks and put them into our own surveillance model. So the question which I have for you is, the most important driver is going to be disclosure in the first instance. First, we got to know what it is. How do you move from your task force disclosures being voluntary to being a little bit more than that? That's one. And again, it's going back to something which you said earlier. How can we use this? How can you use big data and AI to make this measurement of risks a little bit more, to give us more bang for the buck there? And while you're at it, can you also tell me why is it that when we have these hurricane warnings, we get always a European model and a US model and never seem to converge, despite big data and AI? Okay.
Well, you want to have alternative sources of data, so there you go. So the voluntary question is a good one. Look, this is still relatively new stuff. And so, again, in keeping with the discussion we've had today, you don't want to lock in a regulatory approach that's half-baked. It could produce poor outcomes. And so, and this, I'll have to qualify and say this is a personal view, and I'm not speaking on behalf of Bloomberg or as a task force member in the FSB, because I think the FSB was clear they really want it to be a voluntary private sector-led initiative. It's intended to kickstart a conversation. I would say we had and this was partly Greg's fault because he was part of the FSB when we got mandated. But
so was Stefan.
Yeah, we had a very short period of time to come up with these recommendations. So I would call them 1.0. You'll also note that they're highly qualitative. And so I think it's up to the financial community and the industry together to sort of figure out what the next version of. They're recommendations, they're not standards, right? And I also am a big believer that data by itself is kind of, I don't want to say useless, but less useful if it doesn't have supporting qualitative information around it, right? And so I think there are jurisdictions, like Governor Carney is already mandating some of this stuff. He's going to be stress testing on climate starting next year. And so there are other jurisdictions that will do that. I'm with you. Oh, yeah. I do think that there needs to be, hopefully the Governor Carney's approach will learn from that stress testing, and that can further inform potential regulator. I do worry that, it's funny, even 4 years ago when we started the task force, the issue really was about what he called the tragedy of the horizons, that climate risk is big and it's long, but by the time it becomes material, it's too late to do anything about it. It's becoming material much faster, I think, than we even anticipated in 2015. The frequency of the storms, the policy implications, because the recommendations are made up into sort of what they call transition risk and then physical risk. The physical risk is very here and now. The transition risk is beginning to accelerate with a number of jurisdictions saying we will be net neutral by 2050. That takes a lot to get there. You're going to have to implement policy requirements that are going to be impactful. And so I think I'm trying to sort of balance the line here. I think they do need to become mandatory because of the scale of the problem. A voluntary initiative you will not get the level of disclosure or the comparability or the ability to aggregate that information to look at financial systems risk. The question is when and how. And so I think you need a little bit more time to sort that out.
Okay, thank you. You didn't answer my European and American model question, but I leave that one there.
I did in the beginning. It's good to have two separate.
Actually, I was just going to say on this issue, the one sector to look at is the insurance companies.
Right.
Because they're absolutely, this is their number one concern, isn't about transition, it's about physical.
No,
and
exactly.
if you sit down and talk to them, as you know, they've got both a problem on their liability side and on their investment side. Right. Both of them are causing big issues. So there is one sector that is actually very focused on this issue, actually.
Yeah, and they have learned more. They've been further ahead on this issue. And the climate models, I mean, they're also worried about addressable market. I mean, you can't insure some of this stuff. So
yeah.
Thank you very much for this. We are down to our last 6.3 minutes, and I thought we could still take a couple of questions. And we still have to answer her question about, in an AI world, how do you deal with fraud? Who do you hold responsible? That's how I'm interpreting the question. Who do you hold responsible, and where do you report it? But we'll come to that. But we have some. Can we have another couple of questions if there are any? Yes, please.
Well,
Hi, Inigo Benguechea from CFA Institute. Greg talked about the benefits of AI in terms of reducing costs for giving advice. Are you guys worried, and this is also for Socorro, are you guys worried about the suitability for investors when those robot advisors advise investors on the portfolios they should hold and whether they represent adequately their risk profile?
Okay, great. And that's it. So let's just go down, start this way, Greg. Maybe we can all have a shot at the two questions that are raised.
On robo advice, OECD has actually issued guidance on use of robo financial advice, and also ASIC did that. And I guess the key thing with robo financial advice, at the end of the day, the company that actually is providing it is still the responsible entity, and therefore they've got to take responsibility for the algorithm that actually is questioning the party in terms of, you know, the appropriateness and their suitability. So it's always the thing, as Tobias mentioned earlier, market regulators have basically had to deal with dealing with algorithms for probably a decade already, because we regulate high frequency trading. So in learning to regulate high frequency trading, we learned actually about what sort of things we need to do with dealing with algorithms. So that then translated when you get to financial services, the approach says, well, you know, you can't sort of say, well, it's like, you know, the dog ate my homework, the algorithm did it. Well, actually that doesn't work. It's a human, a company, a responsible financial service provider is responsible for the algorithm. And so if it's inappropriate advice, you still get to sue the financial service provider. Yeah.
Right.
Okay.
Yeah, fully agree with that. If the raw advice is part of a supervised company, the supervised company is responsible for whatever advice has been given. Of course, this is also a market conduct issue for robo advice being provided by third parties that are currently non-supervised, and there is an issue for the market conduct regulators how to expand the perimeter to cover these service providers that are currently unsupervised. Then regarding to fraud and who is responsible for reporting in this type of world, from our standpoint, it doesn't make a difference whether it's this type of world or the more traditional type of world. Supervised entities are sort of responsible for reporting the fraud, whether it's within artificial intelligence world or a traditional world. In our particular case, we require all financial institutions to report to us in a sort of an operational risk framework to report different operational risk type events. Fraud is one of them. So they are reported. Of course, we deal with quality of data, quality of reporting. This is a long process, as it was originally with the credit risk reporting that now has been mostly tackled. The beginning of reporting and creating good data on operational risk, it is a long process to try to improve the quality. We are not there yet. We are receiving the information and we see, well, sometimes it's garbage. So, but we're still working on it.
Lisa, do you agree?
Yeah, I agree, and I would say, you know, just going back to a point made earlier, I'm a firm believer, especially in the financial institution, that this concept of robo anything, right? You know, I'm a little bearish on that to say, and I would like to say that I still, you know, believe, and many of us believe, that we want to get to a point where we can recommend, right? And we can, you know, recommend with some level of accuracy, but you always want to have that human aspect to it, because there may be other, you know, ancillary things and other things about the overall ecosystem of that client or the industry that need to be taken into consideration, that maybe the model hasn't learned, or, you know, it hasn't even, you know, we haven't even thought about, that will only come from a conversation, and will only come, you know, from, you know, sort of this human cognition that needs to be, you know, right side by side with the data itself.
Curtis, any final thoughts?
I think I'm good.
So thanks. Well, thank you all. I mean, it's been a fascinating discussion. When this started, I wasn't sure how we'd put all these three things together, and I think we managed to connect the dots in many ways. And I think, but if I were to paraphrase something which Lisa said, that reality is much more than hype right now, but tomorrow we'll all be data scientists. Yes. I think that's the vision of this particular discussion as we've had this. The other very important points which were made were about data governance, and the fact that it is something which is imperative to develop global frameworks, and for which you require global cooperation. But as was pointed out, speed is the key, because developments are taking place so fast that you cannot take the usual 6 years to come up with the Basel II kind of approach. Sorry, Stefan, I wasn't meaning anything there. Okay. And I think one more point which I think, Curtis, you made, which I really liked, was the fact that you said, let's not lock in half-baked regulatory initiatives. And it's important to, runs a little counter to this, but on the issue of disclosure, something which is so important, it's very critical to get things right before we start feeding things into our models and measuring climate risk. So on that note, please join me in thanking the panel.
Thank you.
Thank you.